Just bear with me. All right. Welcome, everyone. Thank you so much for joining this session. For those who don't know me, my name is Dinara. I joined Nexia 3 or 4 months ago, and I work in the global office in London. And I am responsible for developing Nexia global audit methodology, and I'm responsible for driving Nexia audit methodology project across the whole network, including developing audit tools, audit templates, and just to making sure that we're doing our audits to the high quality and also in the most efficient manner. I'm very passionate about data analytics, and I believe this is something that can help our life easier, and this is something that I'm planning to work on next year, so watch the space. Today, what I'm going to talk about is what tools and materials we have developed over the last 4 months. For those who joined me a couple of weeks before, you probably know that we have developed sampling tool that is available for free to all Nexia member firms. The sampling tool, you can find it and download it on the members area. And I'm just going to quickly stop sharing to show you where you can find it. All Nexia materials can be found on members area. And you go to members area, you go to service lines, audit and assurance, and under audit publications and guidance, you will see all the materials that we have published. So, for example, sampling tool is here. You download the sampling tool, and it also has instructions on how to install the sampling tool and additional briefing on how to use the sampling tool. But it's not what we are going to discuss today. Today, we are going to focus on controls, groups, audit, and materiality. And you might ask why these topics. These topics are driven by our quality network reviews. I closely work with a colleague called Rayland, and Rayland goes around the firms and reviews the audit file. And one of the topics that Rayland frequently see, where we sometimes not as tight in our documentation or in our approach, are controls. Another topic is group audits, just purely because there is a new revised standard on group audits, which changes our approach to how we do group audits. And finally, materiality. And materiality is chosen as a topic purely to drive consistency across our member firms. So we all know, and that we're all doing, when we set materiality, we follow exactly the same steps, and we use the same consistent percentages when we set materiality. So this is what we are going to talk about today. If you have any questions at any point, just please post them in the chat. And if we run out of time, I will definitely revert back to you. Or if you don't want to post anything in the chat, but you have a questions, just please feel free to reach out to me directly. You can find my details on the invite. All right, let's dive in. Controls. When it comes to controls, I think the first impression or sentiment that I'm getting from people is, oh, controls. And the reason being is because controls have a bad reputation in terms of the audit testing. Teams sometimes don't understand why they're doing controls. It's a lot of work. Sometimes it requires quite a lot of judgment, quite a lot of knowledge about the business processes, and overall, why to bother? And the reason being why do we need to bother is because under the ISO standards, we do have to do minimum controls testing. And I'm going to explain in a minute what do we have to do. But before that, let's start with the basics. And the basic is, what are controls? ISO defines controls as a policies or procedures that an entity establishes to achieve the control objectives of management of those charged with governance. And it includes policies and procedures. The key here is a control objective. And this is your first sort of a test of whether it even make any sense to do your control testing. Because remember, when we talk about controls, there are 2 distinct steps we have to do. The first, we have to test the design and implementation of controls. And the second step if we decided to proceed further, we will test operating effectiveness of these controls. So the first point, the first sort of a red flag, if you will, in your decision about, do I really even want to rely on controls, is control objective. And it's really important. So when you read controls, so when you talk to the person who does controls, particular control organization, you need to be crystal clear in your mind that you understand what that control is trying to achieve. And by control objective, I mean that control is designed to address risks of material misstatement. So when you're talking with a control operator or you are reading information about controls, if you're not sure what the control is trying to achieve, do chat with management. And if they're not sure, then it's your sign that, well, controls are not accurate. They're not designed, probably not designed as they should be. So this is your first thing that you need to do. Do check that you understand what control is trying to achieve. We are not going to, I'm not going to cover everything about controls on this session. I'm just going to focus on when we have to test design and implementation of controls. But I also want to make sure that we understand that we're all on the same page in terms of what controls are. Typically, we have two types of controls, preventative controls and detective controls. Preventative controls are controls that help the entity to help entity not to make errors that will result in material misstatement. And detective controls are those controls that they help to spot that errors occurred, and they help to flag that something needs to be done to correct this error. So there's two types of controls. The reason I'm listing them there is because later on, when I will be talking about what we can offer as a guidance to you, preventative controls, they generally operate on a less frequent basis, which means you have to test less instances of control. And detective controls, because they generally targeted to spot errors in lots of in a big population, they are operating more frequently, and hence you will have to test more instances of controls. So I hope we're all on the same page. So controls are policies, procedures that are designed to achieve control objectives, and generally we have two types of controls. So you probably remember I started with, whenever we think about control, we're just like, we don't want to test. And it's fine. We don't have to test operating effectiveness of controls if we think we can get audit evidence through substantive procedures. It's absolutely fine. However, under auditing standards, as a minimum, we will have to test design and implementation of controls. Here on the slide, you will see instances when we have to test design and implementation of controls. So the first instance where we have to test design and implementation of controls, when we simply decided that we are going to test operating effectiveness of control. So if you are committed to testing controls straight away, then yes, you have to test design and implementation. So it's not rocket science. The second instance where we have to test design and implementation of controls is when we have significant risk, and also when we are testing journal entries. And this is something that we see in our quality reviews, is that sometimes teams identify significant risk of material misstatement, but they forget to test design and implementation of controls. And the same goes with journals. So the second point is important. If you take away 1 point from the whole hour, and I want you to take this point, when it comes to if you have significant risk, and when we test journals, you have to test design and implementation of controls. You don't need to test operating effectiveness of controls if you think you can get audit evidence from different substantive procedures, from substantive procedures, but you absolutely have to test design and implementation of controls when you have identified significant risk and when you test journals. So this is a must. And another must, which is highlighted at the end, is now in a world, we operate in a world where there's quite a lot of technology, and some of the controls have IT element built into controls. For example, there might be a control in the operating system that matches your invoices to your payments and to your, for example, contract. So if it all matches, then the transactions, for example, gets authorized. And if something doesn't match, Then there is an exception report produced by the system, and then there will be a person who will be going through the exception report to come up with the next course of action. So this is a classic example of a control that has automated element, and it has a manual element in it. So in this case, for example, if we assume that this control addresses significant risk, we will absolutely have to test design implementation of controls, including IT element. So do think about what controls is comprised of. And this is the thing. These controls, I think what is difficult is we kind of go into it, but we look at it holistically. But important thing is with successfully testing design implementation of controls and operating effectiveness, if we feel to, is stripping the controls to component parts by answering simple questions. Do I understand what control objective means? Is it tied to an assertion? Is it tied to the risk of material misstatement? Do I understand which IT control is using? Do I understand what data is used by the what kind of reports are used by the control operator? So these are important things that we need to do. And to help you to do your audits, we have developed the extract from so it's an extract of Nexia audit methodology on controls. And what it does is gives you in a question and answer format, gives you answers to some of the questions. Admittedly, it deals with a situation when we have committed to testing operating effectiveness of controls. I'm planning to develop further guidance that will help you with design and implementation. But however, this is the next. This is the first step in helping you to test controls. And what let's see if I can open it. What this document does, just enter show. So what this document does is it gives you a practical advice or it gives you a methodology that you can use when you test in operating effectiveness of controls. For example, it helps you to decide on how many instances of controls you need to test, and it depends on how frequent your control is operating. So it's annual, quarterly, monthly, weekly, or if your control is operating less frequently, then more frequently you will have to test more instances of controls. Two things that I want to touch here is the first thing around control testing when we are testing controls that are addressing the same assertion. For example, you are testing a preventative control, and you're testing a detective control, and they're both targeted to the same assertion. So what it means is that you might reduce your control sample size when you're testing detective controls. And here's an example of here. The second point that I want to mention is it's always heartbreaking, isn't it, when you test? So you committed to testing controls, so you took this leap of faith, and then you are testing your controls, and you are at the end of your test, and then here's a control deviation, i.e. control is not operating how it should operate. And in this case, our advice, and here's the guidance, is to think really hard whether it makes sense to extend your control testing or just cut your losses and switch to your substantive testing. So this is something to think about. So not only you need to have a commitment to testing controls, but also when you are testing controls, you also need to know when to stop. Extending controls, testing more instances of controls when there are control deviations gives indications that controls are not operating effectively. So after all of this, you will ask me, Dinara, why to bother with controls to begin with? And the reason being is, let me just check. The reason for bothering with controls is if you testing substantively, because controls always goes with substantive testing. If you tested controls and they operate effectively, what it can give you is that it can help to reduce your sample sizes. And also, the reason to test controls is on some simple engagement, it might not be beneficial to test controls because the smaller firm is, the more likely the controls will be kind of more informal and will be kind of very difficult to pin them down. But if you have maybe a big engagement and there is a particularly complex area, for example, estimates, you would want to test controls because when it's complex judgmental area, you do want to get as much audit evidence as possible, and controls are one of them. To summarize this section on controls, what I want you to take away from this session is, there are instances, there are requirements when you have to test sign and implementation of controls, even when you're not testing operating effectiveness. And the examples are when you have significant risk, you will have to test design and implementation. When you are testing your journal entries, you also have to test design and implementation of controls. And if these controls have IT element, you have to test design and implementation of IT controls as well. And you also need to test design and implementation of controls when you decided to, test operating effectiveness. So remember that even if you're not relying on controls at all, you still have to test design and implementation for significant risk in journal entries. So this is what I want you to remember. And also another thing that I want you to remember, if you committed to testing operating effectiveness of controls, please use Nexia audit methodology to determine your control sample sizes and to determine what to do if you have control deviations. So this is what I wanted to tell you on controls. The next topic that we are going to talk about is group audits. And I'm conscious that I'm not sure about the mix of attendees. i.e., are you group auditors? Do you do group audits, or you're doing the component audits? So I will try, as I will be going through the slide, I will try to look at it from both perspectives. What I think the main kind of thought that I want to convey when it comes to group audits. Yes, we have a new revised standard on group audits, but essentially what it means in a nutshell is that now as a group auditor, for example, if you put yourself a group audit head, you just need to do group audits exactly the same way as you do your standalone audits. You know that under standalone audits, what we do, we start off with understanding of the entity, we identify all risk of material misstatement, we identify significant accounts, we look at we identify assertions, then we assess each assertion, and then we plan our audit work. So this is what we now have to do for group audits. For those of you who remember old standard, you remember what happened before. So if you're a group auditor, you identify some significant areas, you send instructions to the group, to the component auditor, and then you basically throw it over the fence, and then you wait for them to, to do their audit. They will throw their stuff back to you, and then you just attach it to your audit file, and it's all done. Which, with the hindsight, is a quite risky, risky approach, because at the end of the day, you as a group auditor, you sign in the group account, so you do need to have a pretty good confidence that everything has been completed in accordance with what everything has been completed to get you this audit evidence. So this is what new standard is taking care of. So it places greater responsibility on the group auditor to make sure that they A, did the proper risk assessment, and B, they've been involved into the component auditor's work. And this is what this slide is explaining, exactly what I said, that the group auditor is now have to do detailed risk assessment. And one thing from the component auditor perspective, so what changed for component auditors is that they now might be asked by group auditor to help with risk assessment. Of course, group auditor is responsible for performing risk assessment, but if the entity is really big, have different jurisdictions, it's really quite difficult for group auditor to identify all risk of material misstatement, because laws and regulations are different, and environmentalist law are different. So there are lots of variation across the whole components. So what group auditor might he might reach out to you as a component auditor and ask you, hey, can you please help me with risk assessment? And what you would do, you would just do risk assessment even before group instructions are issued to help group auditor to identify group risks of material misstatements. So this is what it means for you. Now switching back to group auditor. So let's assume we have done all the hard work. We did our risk assessment. We have identified group's risk of material misstatement, and we involve component auditors to do it. And now we need to scope decide which components we're going to do work over. And you probably remember under old standard, it was pretty straightforward. So it says, okay, you scope in your individually significant components. And I think standard even gave example of 50% of total revenues, if I recall. And then you also scope components that have significant risk. So now under new standard, it's changed, and it's changed because of the risk-driven approach. And here's a little flow chart that can explain the steps of how group auditor now scopes components. So it starts with, as in any audit you're doing, it starts with getting as much information as possible from your risk assessment. So you understand the business, you understand external factors, internal factors, you understand the general economic conditions, you understand availability of debt, any laws and regulations, any fraud risk factors. So you get as much information as possible to help you to form kind of initial assessment of what kind of risks you might see on this engagement. And understanding, obviously, of business processes is a key. The second step is you basically get the list of all your components. And important to know that you just get all components that make up group financial information. So it's kind of like your basic completeness check. The third step, which is more prominent now in the new standard, and that's what I love about it, is now, so you know roughly which group risk of material misstatements you have. You understand your entity, the groups you're auditing, so you can step back and ask yourself, as a group auditor, is there something that I can do centrally? Because let's face it, as a group auditor, it's quite a tough gig, isn't it? You have to talk to component auditors, you have to draft instructions, then they do some work, then they send results to you. So it's quite evolved process. But if you have ability to test accounts centrally, this is even better. An example will be, for example, revenue. Let's assume it's a revenue recognized at a point of time. And it's the same revenue across all components, and it's the same type of contract, the same recognition principle, as I said, the same financial reporting systems, the same distribution systems, all the same, all controls are operating exactly the same, and it's all kind of exactly the same, it's just in different locations. And because you as a group auditor have access to all this information, including all supporting documentation that you need for your audit, you can decide that actually maybe I will just do it on my own. And this is a good thing, isn't it? So you can do your audit more effectively. So this is the step 3 of your group scoping approach. So you decide which significant accounts you can test centrally. The next step 4, after we have identified accounts that we can test centrally, we now need to identify individually relevant components. So remember, before we had to identify an individually significant component just purely by size. Under new standard, it's risk-driven approach. So you will identify individually relevant components. And how do you do it? Again, you look at such things as, does this components have lots of groups risk of material misstatement? If yes, you probably scope them in. Does this component have significant risk for group for financial statements? Yes, you will scope them in. And another criteria that you might use is size. If component is big, most likely it will have lots of group of risk of material misstatement, so you probably would want to scope it in. So you kind of looked at the whole the whole consolidation matrix vertically. So you know which components you scoped in for the audit work. But this is only the one step. The one step in the 4th step. What you would need to do after you looked vertically, you need to look horizontally. So you go basically by group, by each significant account, and you look across to see how much have you scoped in for audit work and how much is left. so-called evaluating, it can be linked to step 5. So you're looking at your residual population, exactly like your standalone audit. When we, for example, doing trade receivables, we selected some balances to test, and then we look at the remaining balances. And if the balance is too big, we might want to scope the balances for the testing. So the same goes with group significant account. You look at the account horizontally, see how much you cover by your audit procedures. Either you do it centrally or by component, and then you look at the remaining bit to see whether you need to scope in more to address the risk of material misstatement in the remaining population. And I appreciate it's quite a lot of information to process. And what is helpful is that I won't be kind of jumping back and forth, but in the maybe I will actually in our materials here under group, which is I'll get this thing. Wait. So in the materials here, actually let's close it. We have a template which I cannot open, but bear with me. Let me, here it is. So we have our template under group, under groups in the members area, and everything that I've just covered, first of all, it's here. So here's our little flow chart. So you can see it, but it's here. And most importantly, what I wanted to show you is group audit FAQs. So these FAQs are important because they give more sort of more prompts for you what to think about when deciding whether you need to scope more components for the testing or not. So it kind of provides you points to steps to go through to decide what you need to do. And most importantly, this template also has guidance on how to set component performance materiality, because remember, once we scoped in the components, we need to calculate component performance materiality. So this is from the group auditor perspective. So the tagline for group auditors is, I have a, difficult news for you. You will have to do more work in terms of the risk assessment. On the flip side, if it's a recurring engagement, next year it probably will be better because you might be able to roll forward significant bit of your initial risk assessment. So you would know already which components you're probably most likely to scope. Obviously, you will have to kind of have a fresh look, but at least you will, the most of the difficult work will be done in the year 1. So what it means for component auditor. For component auditor, it depends on which type of work group auditor is asking you to do. If you were doing audits, if you were doing full audit before the component auditor, probably it won't make much difference in terms of your actual work. But if you were doing other bits of work, for example, you were doing specified audit procedures, if scope changes, that you will be doing more work. But what changes, especially for component auditor, is, remember in the beginning I said how we did audit before, you just throw instructions over the fence and then they throw the results back to you and you just like, okay, thank you very much, here it is. So now group auditor and component auditors, they expect to have a close communication with each other. And the reason being, because the fundamental difference between old standard and new standard is that group engagement team now involves everyone, i.e. component auditors as well. So like on your normal audits where, you sit in a room with your managers, partners, and you're all kind of talking to each other and consulting, things like that, the same concept applies to group audits. Obviously, component auditors might be in different locations, but the same level of communication. So group auditor is expected to be involved in what component auditors are doing. And what it means is group auditor might have a frequent check-ins with component auditor just to see how things are going. Component auditor might update them, or, we have tested XYZ and actually something transpired. You might want to check in at a group level to see whether other components have the same problems. So it's all kind of keeping the communication flow going like a normal audit to make sure that risks and issues are addressed as soon as they arise. So it is, it is quite a big change from what we are used doing. However, there is a help. So on the members area, I showed you the group scoping template. So you can use this template to scope your audits. There is also a template to help component auditors. To help group auditors to review component auditors' work. So it's exactly on the same page. So do use these materials to help you with your group audits. To summarize, component auditors, what I want component auditors to take away is expect more involvement from group auditors. Expect your work papers to be reviewed by group auditors and be prepared for them to be closely involved in what you are doing, especially when it comes to significant risk. If there are significant risk you identified at component auditor, group auditor will have to check the design of your procedures. So expect this frequent back and forth. For group auditors, do your risk assessment. Risk assessment is always important, regardless of whether it's group audit or standalone audit. But with group audits, you kind of need to walk a fine line. So you want to make sure that you identified all risk of material misstatements, but also you need to make sure that you are not over auditing. So you need to be really precise with your risk material misstatements and ask yourself, is there a risk or not? And do get involved in working with your component auditors, because ultimately you have to demonstrate that at every single point of group audits you were involved, and you can vouch for whatever conclusions component auditors made to support your group audit opinion. So this is what I wanted to talk about on group audits. And again, I will share the slides and I will share the recording. And here's a reminder where you can find additional information. All right, and now let's talk about materiality. Materiality is one of those topics where I don't think there are a lot of difficulties. I think people just kind of feel confident in how they set materiality. You just basically take a number, take a metric, and you select a number, and then if a number looks all right, you're good to go. However, what I find is with materiality, you can either set to high materiality or you might say to low materiality, and neither of which contributes to a high quality and efficient audit. And that's why what we have been working on is we have developed a materiality template, which is available in members area, which takes you step by step on how to set your materiality. Materiality is a judgment. So it's what auditing standard doesn't even define what materiality is. What materiality is sort of defined by accounting standard, which says material is when it's when omission in disclosure or incorrect accounting treatment might influence the decision of the users of the financial statements. This is what material means, and it is a judgment. However, I believe that if we just follow the steps, the standards ISO 320 outlines, then we will be able to make this professional judgment a bit more easier for us to execute. And the template, I'm not going to jump between the screens, but the template just basically split your materiality approach into 3 or 4 distinct steps, and it takes you from selecting your metrics through to the whole process. And here's a little flow chart that basically repeats what the template is doing. And I think we start off with identifying the users of the financial statements, and this is really critical. Quite often I've seen that we just, rush headlong with setting materiality without even understanding A, what is the business of the entity, and C and B, what the users of the financial statements are. So it's not only the management, so you need to think wider. It might be lenders, banks, it might be tax authorities, it might be suppliers, it might be employees. So you need to identify all of them. And you need to think what they would be really interested in. For example, banks probably will be more interested in, for example, debt covenants. So they will be interested in net assets, or they will be interested in EBITDA if EBITDA is used for debt covenants. The managers owners maybe will be interested in profit, and so on and so forth. So once you identify the users of financial statements, the template will ask you to select the scenario which is close to your entity. For example, it might be bank, or it might be general. For example, general, it means it's just any retailer, for example, or it might be scenarios where you have entities that have lots of material assets. After that, after you selected the scenario, it will give you examples of benchmarks and metrics that are most closely associated with the scenario. And one thing that I think we are frequently missing, because we are so focused on benchmark, we forget that, yes, the benchmark is important because it's what we use to set materiality, but there are other metrics that are equally, or not equally, but they're important to the users of the financial statements. So that's why the third step is important. So you identified all your metrics, and then you need to sort of to rank them. So if we're talking about profit-making entity, your most important benchmark probably will be profit. The second important benchmark will be revenue, and the third important benchmark will be, let's say, net assets. So this is your priority, and why it's important, I will explain later. So let's assume we have identified all our metrics and we have defined the benchmark. The next thing that we need to do, we need to determine the actual amounts of the benchmark and the metrics. And here, what is important is to not discard profit straight away. What I see sometimes we do, so we look at the profit and we're like, oh no, profit is too small and we're not going to use profit as a benchmark. But the first thing is to ask yourself, is there something in profit that makes it small? For example, you might have something that is not part of the normal continuing operations of the business. Maybe there was loss on disposal. For example, if you sell parts of your entity, it's obviously not normal operating. It's not part of the normal continuing business. It has nothing to do with how business operates. So you probably would adjust for it. Or if, for example, there was a huge, some forex loss, or something that is not part of how entity makes its money, then you might actually adjust for it. Or another good example, if it's the entity that is that's managed by owner, and they take out big dividends. Also they take out, let's say, big salary, which is so big that it almost amount to the dividends. So it will artificially dampen your profit. So you might consider adjusting your profit, and profit will increase, and you can use it as a benchmark. So just main point is, don't discard your profit straight away. See whether you can adjust to make it bigger and use as a benchmark. So there might be a perfectly legitimate reason why you can't use a profit, and it especially works prevalent for the entities that have a low margin. And in that case, you might have a huge balance sheet, you might have huge revenue, and while profit is important, it's really small. And if you use profit as a benchmark, then you will be auditing everything under the sun. So while I said initially that you do need to select the benchmarks that's most important for the users of financial statements, you also need to think efficiently. Does it reflect the size of the business? And if benchmark is too small, then you need to look at other metrics. So we have selected our benchmark, we determined the amounts, and now we're about to determine our materiality. What is important is to think about the factors when you determine your amount. So, for example, quite a lot of teams just start with a number. So they set a number, and then they look at the percentage of this number against the benchmark. And as I said, in Nexia, we have developed the range. So this is the tables that are in the materiality chapter, and it provides you guideline ranges on how to set your benchmark, how to set your materiality based on various metrics. So it's not kind of like I can't step outside of the range. No, you can, but it's just kind of helps to guide you to the right conclusion. And so we have set these ranges for different types of metrics, and depending on the entity, you might go up. You might go to the higher top of the range or the lower top of the range. For example, if I'm auditing listed client, I probably will start with a lower range because of the importance of the listed entity. It affects quite a lot of stakeholders. If it's private entity, I might start in the middle, and then I will look at the factors here. For example, level of debt, business environment. So, for example, I have a private owned entity, and the business environment is really unsettled, and there is a high level of debt. So I probably will, instead of starting in the middle of the range, for example, for total revenue, I probably will start sliding, towards the end of the range and lower end of the range. And remember, in the beginning, I told you about ranking your metrics. So the reason it is important is you don't want to end up in a situation where your materiality only reflects one metric, one benchmark. Because we know that users of financial statements, they are interested in profit, they are interested in revenue, and they are interested in net assets. For example, we ideally want to have a materiality amount that is close or within the ranges for all this metric. For example, I don't want to be in a situation where I have set so I'm profit-making entity, and I set my materiality based on revenue, and I don't know, it's 3%. But when I calculate materiality against profit measure, it's 20%. It's clearly wrong. The reason wrong because it's so outside of the range. You do need to take into account the importance of other metrics. So it's like, imagine like stars. So you have a star or you have a planet, and it's affected by gravitational pull from nearby stars. So the more important the bigger star is, or in our case, the more important metric X is, you want closer your planet to be to that star. So you kind of want to almost find an equilibrium where your materiality amount is sort of falls within the ranges or close to the ranges for all relevant metrics. You don't need to be within the ranges. You don't need to be really close to the ranges, but you need to make sure that you don't end up in a situation where, for example, you decided to set your materiality based on total assets, and the number is just so huge that you don't audit your P&L at all. So if you take away one thing from materiality section, it will be when you set your materiality, don't just look at the one benchmark. Look at all other important metrics and make sure that your materiality amount is either within the ranges for this metric or just outside, taking into account the importance of that metric. If, for example, you have, 3 metrics and net assets are not important at all, then of course you don't need to be close to the ranges for that net asset. It may be kind of maybe what do we have, 4, 5, 6% of net assets. But if net assets are important, then you want to be close to that range. So it's on materiality. The guidance, we also released the guidance on performance materiality, and we provided the ranges on how to determine your performance materiality. It's all based on aggregation risk. And aggregation risk is that aggregate of uncorrected and undetected misstatements individually below materiality will exceed materiality for the financial statements as a whole. And what template is helping you, it helps you to go through all these steps or all these points to ask yourself how high or how low I want aggregation risk to be. So for example, if you have lots of past misstatements, or you have high turnover of personnel, or management is overall reluctant to correct your misstatements from prior year, or you just know that transactions are very complicated and require lots of judgments, you probably would not go for normal aggregation risk. You probably will go for lower. So do use the template to help you to decide where you are in terms of your aggregation risk. And another thing that a template does, it reminds you that it is important to reevaluate your materiality as audit progresses. And the key is reevaluate as audit progresses, because I've certainly been in quite a lot of situations where, you're almost done with your audit, you're about to sign audit opinion, and then surprise, you realize you need to, look at your updated benchmark because there have been corrected misstatements, and you also need to think about your uncorrected misstatement, and the benchmark decreased significantly, and your materiality is just way too high. So do plan do it not at the end of the audit, but consistently to make sure that you performed audit at the required level of materiality. Right, I'm going to end show. And I'm just going to quickly show you where things are. So this is a materiality chapter that I have wrote, and it covers. So it's the full chapter, so it covers every single requirement under ISO 320. And what is good about it is it's in question and answer format, and it kind of helps you to understand the whole materiality concept. And as I was saying, so here's the ranges and explanation on how to apply the guideline ranges. So it's kind of help you. It basically takes you step by step through every single requirement in the standard. And the materiality template, which I can't access now. Sorry, let me just remove this one. Oh dear. Here it is. Here's the template. As I was saying, so it has planning with all the steps that I was referring to. And here's this neat table. So remember, I was saying to assess your materiality against other metrics. This is what essentially, I don't know whether it's going to, because it's not checked out. But anyway, so it will automatically calculate where your materiality sits against other metrics. So it's quite a neat template. And here's the FAQs as well on how to that help you to answer questions as you go through your materiality template. Another thing that I wanted to mention, and I'm going to stop sharing now, is I would really appreciate if you can use the templates and most importantly, feedback to me what you think, or is there any other areas you would like us to work on? We do want to make audits fun, and I think audit can be fun because what you're essentially doing, you are trying to understand the business processes, you're trying to help the client to identify risky areas. It's quite interesting, but sometimes there are also not a lot. Sometimes some areas that are not that particularly interested, for example, ticking all the invoices or sampling, and this is something that we are working on. So we want to help you to do your audits and want to bring some fun. So do feedback with your ideas or your feedback on anything that we are doing, because it is I'm paying attention to it. I'm passionate about making our life easier. And we have 10 minutes left. Do you have any questions? I'm checking Q&A. No, there are no questions in Q&A and no questions in the chat. I'm happy to answer any questions if you have, or if you feel a little bit shy, which is absolutely fine. When I also feel shy, do feel free to drop me a message. Just gonna post my email address. Here's my email address. So yeah, do you have any questions on controls, on materiality, on group audits? Group audits is quite a complex topics, and what we have in pipeline for next year, because the standard is applicable for for periods commencing, if I recall, 15th December 2023. So this 2024 year is the first year when everyone is using standard. So because we have lots of member firms, what we're going to do, we're going to kind of collate the experiences, the issues, the difficulties that they have encountered when they were doing group audits, and then we will also update the template. And one thing that I forgot to mention, on the members area under the group sections, we actually have group audit instructions. It's a template, optional template. We released it quite late, so I think probably quite a lot of teams who were planning their group audits are already far advanced. But this template will also be updated in 2025 to incorporate everything that teams encountered as they were doing their group audits. Any questions at all? Is there anything you're working on that you're not sure on these topics, or if you have questions on sampling? Speaking of sampling, I think I forgot to mention, or maybe I did mention it. When we're testing controls, when we committed to testing operating effectiveness of controls, if controls are operating effectively, then in sampling tool, if you guys have a chance to use a sampling tool, you can select control reliance as your input, and then it will substantially reduce your sample sizes. So this is one of the incentives of testing controls. We do have a couple of minutes. Let me just, hold on. There is some message maybe. Let me actually cover one slide that I haven't covered since we have a bit of time. What have I done? Sorry. Oh dear. One thing that I wanted to touch quickly upon this slide, tips on how to evaluate DNI of controls. So what I find personally difficult with controls, as I was saying, is it's quite, I don't think it's as kind of black and white as, when you do your other, and when you do your other audit procedures. For example, when you, compare invoice to, to cash, or to bank statement, it's quite clear. So you do compare certain things and you know what you're doing. With controls, I think what is difficult is that you're not quite sure whether, control is written appropriately, whether it's achieved what it's supposed to achieve. And this here, I put some tips together to help you to assess whether controls has been designed and implemented appropriately. And the first thing that I already covered was control objective. We do need to understand whether it's clearly linked to the risk of material misstatement. Another thing is a control type. So we need to understand what type of control it is, if it's preventative or detective, and because the reason being it has an impact on frequency of controls and precision. So if it's detective control, it means that it's probably operates on a big data, so it needs to be frequent enough to spot errors, to prevent errors accumulating. Another thing is assess the level of precision. One of the things that you probably encounter if you ever tested control is so-called management review controls, where management just sign off, something. And this is the thing. If just management puts their signature somewhere, it doesn't actually mean that they have checked the what they were supposed to do as part of the control. So this is where a level of precision comes in. So if you're talking to a control operator and they told you, here's evidence that that person has reviewed something, you need to have evidence that that person actually reviewed it. So there might be tick marks, or there might be some back and forth on the email saying, he was saying, look, I have reviewed your report and I have questions on this and these lines. This is your evidence that there is a certain precision. So the person actually does review what was given to him. If the person just, signs something with closed eyes, this is your red flag that control is not designed as it should be. Because if person is not looking what they're doing, it means they can easily miss material misstatement. Also, important thing is to understand whether the person who is operating the control is actually understand what they're doing, whether they're qualified enough. And this is quite easy to do. You can just, have a conversation with them asking, okay, how do you go about executing this control? How long have you been working in this particular area? How long you've been with the firm? So it's quite easy to assess. And important thing is something that we quite often forget is data. Data is a key, as you know, and if there is some sort of a data used in control, for example, I was referring to exception report, or any data that control is using, we do need to test this data. So it's quite important not to miss it. Okay, so I think this is everything that I wanted to